Hi and welcome. I'm Sarah Hefner with Fetch Freight, and thank you for joining us. We'll spend the next hour looking at freight forecasts for 2024, specifically for truckload rate and market trends in North America. If you have questions throughout the discussion, please submit those to our panelists using the chat feature, and we'll cover these later in the hour. Now let's meet our panelists. We're thrilled to have Tim Denoyer, Vice President and Senior Analyst with ACT Research. Tim joined ACT in 2017 after 15 years in equity research, focused primarily on the transportation, machinery, and automotive industries. Tim is the lead analyst in ACT's transportation research effort and the primary author of the ACT Freight Forecast, which provides supply chain professionals with better visibility on the future of pricing and volume in transportation, including truckload, LTL, drayage, and intermodal. Welcome, Tim.
Thanks, Sarah.
Next up, we have Brett Lankford. With experience in operations in major 3PLs, he leveraged his expertise as transportation manager at Conagra Brands, then served at Campbell's Soup Company as the corporate transportation manager and business process lead, guiding Campbell's transportation strategy through the challenges of COVID. Brett then accepted the role of Director of Strategy and Innovation at Fetch Freight. He has a MicroMasters in Supply Chain Management from MIT and an MBA from Auburn University. He has been pivotal in developing Fetch IQ, an exclusive AI-driven TMS designed to optimize cost-efficient solutions for shipping customers. Welcome, Brett.
Thanks.
And leading today's conversation is Mitchell Lewis, founder and president of Fetch Freight. Fetch is an organically grown, rising national leader in the 3PL industry. Mitchell took his experience from small shop to billion-dollar brokerages and his work ethic of going above and beyond for customers to drive the success of Fetch Freight. His team brokers shipments for national enterprise brands while tailoring local and regional deals for his customers of all sizes, including multiple Fortune 500 shippers with a 60% increase in volume year over year. He was recently named finalist for Top CEO in Birmingham. As Mitchell continues to grow Fetch Freight, his values remain the same: build strong partnerships, innovative solutions, and exceed expectations. Welcome, Mitchell, and thank you for facilitating today's conversation.
Thank you, Sarah. Welcome to all of our attendees today. Whether you're on one of our shipper partners, an asset carrier, or one of our industry peers on the broker side, on behalf of Fetch Freight and ACT Research, let me say welcome. We hope our time today will be beneficial as we kick off what will surely be another interesting year in transportation. And at the end of the day, we're here to review the January 2024 ACT report freight forecast. You know, and I wanted to say, interestingly enough, we've been working on this for roughly 6 months. And I thought it was interesting that we did not finalize today's agenda until Monday. And I think that really speaks to how fluid things are in this industry, how quickly things can change, and how we all have to be on our toes and looking around the corner, so to speak. So with that being said, let's get started. So Tim, thank you so much for joining us today. We appreciate all that ACT Research does for us here at Fetch and the industry as a whole, and educating us and helping us prepare for changes in markets and just knowing how to plan for what's ahead. So with that being said, welcome, Tim, and let's dig in. So we'll cover three slides, main slides, looking at demand conditions, supply, and ultimately the forecast. So let's get going here. The very first slide we have is really focused on demand conditions. Tim, with container rates, this is a slide we received from you. Container rates are way up over the last few weeks. And can you tell us a little bit about why that is and what impacts this could have on the year ahead?
Absolutely. First off,
Mitchell, for having me, and we appreciate the work that you do, and we appreciate the partnership as well. As we start to look at the outlook for 2024, I think it's really fascinating right now, and really probably the source is just this 94% spike in global ocean container spot rates in the first 2 weeks of the year is a nice way to kick it off.
Yeah.
I mean, not nice if you're a shipper.
Yeah,
but
right.
interesting way to kick it off. Certainly there's a lot of disruptions across the oceans. It's not just what's happening that we're hearing about pretty much every day in the news right now in the Red Sea. But the Panama Canal issue has been brewing for quite some time. And I think the confluence of those two things, neither of which seems like it's going to end soon, are starting to really press freight in a lot of different directions around the globe. The capacity impact from rerouting ships from the Suez around the Cape of Good Hope, which is largely what's happening right now, is really significant on the ocean. And I think demand is recovering in general. I think we're seeing some good signs regarding U.S. goods consumption trends, and we can get into that more. But I think the biggest factor in this jump is that supply pinch on the ocean. So 100% of that's not going to transfer over into surface freight, but there's going to be some really interesting reverberations and implications through the year.
Okay.
Yeah, Tim, I just want to read out a couple stats, but you mentioned the Cape of Good Hope, and I think for the casual observer and for many of the attendees, you kind of alluded to it in the news cycle. You're hearing about the Houthi rebels, the impacts on container shipping through the Red Sea. Recent print is 80% of the container freight through the Red Sea is rerouted along the Cape, including Maersk, who's ceased operations through the Red Sea. I think that's pretty interesting. But overall, these two issues you highlighted, the Suez Canal and volumes, decreasing through there, as well as, the water level issues, challenging throughput with the Panama Canal. Overall, the impact is that East Coast port imports will be a challenge, logistically. Lead times going around the Cape, increase significantly, has impacts on restocking, impacts on inventory. But is the big winner the West Coast in this situation?
I think yes. I think that's the very clear answer is that we've had this big shift over the past couple of years to all water shipping to the East Coast, really taking advantage of that deeper Panama Canal, and that's just not available right now. And so that is quickly shifting back to the West Coast. And so from a global just mode perspective, ocean's going to lose share to land this year.
That's interesting. I think when you think about the West Coast as potentially this big winner of this volume for imports, thinking back to the pandemic, there's probably a lot of trauma and scar tissues for those who were involved with that type of operation. You think about the videos and the images of container ships anchored off of port. You had union labor constraints also at the ports. What's different this time around? If I'm a shipper or an importer, I'm maybe hearing this probably brings up some bad memories, but are conditions different today than they were in the pandemic that might be able to facilitate that volume?
Well, that's a good question. Actually, the labor point is a really interesting, different this time because a couple of years ago it was the West Coast labor negotiations, and coming up this year we have East Coast labor negotiations, and so that only serves to reinforce that trend pushing towards the West for now. I do think that a lot of capacity has been put in place on the intermodal network, and I think that continues to be a big question, frankly, of how the network can scale up this year. We're experiencing some cold weather right now, and we can talk more about that. But the intermodal volumes are under a little bit of pressure just this week, and we're seeing some of that start to spark some activity in the truckload spot market this week.
That's interesting. You mentioned intermodal. I was actually kind of curious, with these imports coming in and, potentially landing, maybe unexpectedly, higher in the West Coast this coming year, kind of as a result of, some of these ocean challenges, is intermodal the big winner when it comes to U.S. surface freight?
I think overall, yes. That's an easy question to say yes to from like a proportionality perspective, because it's not a huge piece of the overall freight network. It's going to have the biggest impact, but it'll be really interesting to see if the intermodal network sort of can grow more than mid-single digits this year. We recently raised our forecast just a little bit from 5% growth to 6% growth, thinking that. I mean, goodness, there's so much demand, but what's holding our forecast back is frankly just not having the conviction that that the capacity is going to be able to respond.
That's interesting. And I think, we've got up here even on the slide, just projections of inventories, and restocking continues to be, such a prominent headline of, have we worked down our inventory levels low enough, the resilience of the consumer. This, when you're forecasting shipment volume, and you can even see down on the bottom right, your shipment forecast through the cash report, you're projecting 5% year-over-year growth by the end of the calendar year. Something you just kind of alluded to is that, this could be a year of growth on the shipment front. Is this restocking narrative, particularly when you think about ocean freight and container challenges, is this the narrative? Is that a key part of what is going into the forecast on volumes?
Yeah, absolutely. Inventories are a big piece of the equation this year, and a huge shift from the 18-month destock that we've just been through. I think that's one of the biggest stories of 2024 is shifting back into restock mode. And the retail restock is certainly still debatable. There's certainly some places in retail that probably could still stand to destock further, but we've already done so much destocking that just going back to a more static inventory environment would actually add to freight relative to last year, and that's where you get some of those easy comps sort of later this year, and you get those mid-single digit growth rates. But coming back to what's happening on the ocean, you talked about the scar tissue earlier a few years ago. I think a lot of shippers are under stress right now in terms of keeping supply chains moving, and all that stuff that was is being delayed around the Cape of Good Hope. You're hearing about plants having to take some downtime here and there, which is extremely expensive. So in the short term, that certainly supports air freight, which is one of the only ways to avoid those types of downtime. And I think that's probably happening in many places just to keep things moving. But we are from a freight volume perspective overall, we're pretty well below trend. If you look at the Cass freight index, the shipments component as a good benchmark, and the forecasting to get back to a pretty decent growth environment keeps us even below trend, I think, through most of this year, and I'm not expecting us to get back above trend until sort of well into 25.
I think, one thing, I think even we spoke about this a couple of days ago when we were kind of talking through the report, but, the container challenges, the spike in price, inventory restock, a lot of times when you think about inventory restock, it's in preparation for demand. You just kind of talked about production lead times and, ultimately, rerouting along the Cape of Good Hope, all that inventory that's in transit is seeing longer lead times, if they reroute. I'm just kind of curious, is this kind of leading into more of a potentially a supply driven restock versus a demand driven restock, trying to get out in front of the capacity rates? Do you think that this could kind of generate maybe a shuffle to try and secure this capacity and ensure that they do have their raw materials and their inbound goods from, Asia and some of those markets? Do you think that could be leading some of this inventory push?
Yeah, absolutely. I think that's what those spikes in rates will tell you, is that shippers are out there basically saying, hey, we have to build safety stocks at this point. Now, to some extent, that'll offset some of the need to rebuild inventories later this year, from just that consumer-driven trend, which is still very, early on. We did get a really nice retail sales number for December just yesterday. Those can be pretty volatile. That's the first reads, but it looks good. And eventually, I do think that retailers will need to restock. Just because the U.S. consumer has reached that point, and we have gone through, as you can see on that chart on the top right there, we have gone through the longest and deepest destock on record outside of recessions. So we're already, we've arguably that it's tough to find the right inventory to sales ratio, I suppose, for the overall economy, but I think there's a real strong case that shippers, well, I'm not suggesting that there's a mad dash for capacity just yet. I mean, capacity generally in the industry is going from loose to kind of balanced, and is in that early stage. But as this year progresses, I think things will progressively tighten.
I just want to read out a couple statistics. This is from deep in the report. I wanted to just get in the macro just very briefly, but ACT Research, your report is kind of predicated on a 2% base case for GDP in 24. The wisdom of the crowds is betting on interest rate cuts coming this year. It looks like your team's forecasted 325 basis point cuts to come through in this year. I think just for the casual observer again, and for the attendees, when you think about this narrative of rate cuts coming, outside of the consumer, more about the freight market, will these rate cuts be enough to serve as a tailwind, or will this kind of keep us close to par for the economic forecast as current? Is this more soft landing relative to current state, or could this potentially be a tailwind for growth? If these cuts do come to fruition.
Yeah, I think that's a great question, and I think that kind of pushes us forward to the 25 forecast a little bit. I think one of the Fed presidents, Bostic, said just yesterday, or maybe even today, that he wasn't expecting rate cuts to begin until the second half, which seems like a reasonable expectation right now. And to the extent that they start cutting in the second half, that's, I think, going to provide some fuel for growth in 2025. I don't think it's going to impact 24 too much, one way or another. I think the sort of optimism in general and I guess relief, if you will, that inflation has come down so much. I think that certainly, is a good sign for growth in the near term. But my gut right now at the moment would suggest that that expectation for 3 cuts next year is a little bit of a risky expectation. And the financial markets are smarter than me, I guess. But what I would suggest is, as we're looking at this spike in global container freight rates and the likelihood that overall freight rates are going to start rising this year, that's one of the disinflationary factors that has helped the overall macro conditions to ease. Certainly energy prices are a piece of that, and oil prices are still pretty low. So in general, I think disinflation, that trend should continue. But there are risks that the labor market is still very tight. Initial claims this morning were ridiculously low. We're still a very strong U.S. job market, and that's going to continue to put some upward pressure on inflation too. So all those things suggest that maybe we won't get 3 rate cuts next year. I don't know.
Yeah.
Excuse me.
Yeah, I thought that was interesting. I think the BLS actually came out with some data today showing, jobless claims were much lower than what was expected. So I think this continues to be kind of a wait and see. A lot of these factors that maybe were forecasted months ago have not yet come to fruition. The odds of recession, even in last year, tail end of 2023, didn't happen. Consumer resiliency continue. It looks like for this year, the economics team at ACT is projecting about a 15% chance of recession, basically sticking to the soft landing narrative. If the interest rate pivot does not come to fruition in 2024, what should we expect from a freight market volume standpoint? I would expect that would be a headwind to current forecasts. Would that be accurate?
Well, other things equal, yes, but I think that would be in the context of a really strong economy. So I think probably no major impact. I think that would be supportive of the forecast overall. And so I think, while the narrative overall from a big picture perspective does not suggest that we're going into any sort of severe recession at this point. There's certainly still some risks from higher interest rates that are out there, and savings rates are kind of low, and there's some concerns for sure. But that soft landing narrative, seems like the most likely outcome at this point. But all that said, if you look at the Cass Freight Index again, we've been through about an 18-month downturn in the freight markets. So while there was no, I guess the overall economy is going to hit a soft landing, but there have been some rolling recessions, including in our sector.
Great. Well, that's great. An excellent just recap of the demand side and where we're looking at right now. So I want to keep us on track here and try to move on over to the supply side. And just to give everybody in case I missed it, we want to allow some time for some Q&A at the end as well. So we'll give ourselves another 10 minutes or so to take a look at the supply side and really just starting out, just, focusing here on the Class 8 market and well, specifically to the Class 8 market. Just Tim, I know we talked about some of the backlogs and where some changes that we're seeing there. Just wanted to understand what conclusions we may be able to draw about overall capacity conditions and where they are, where they might be, what the trajectory might be, given our current readings on Class 8 trucks.
Yeah. This is, I think, as you know, we think this is kind of the most important piece of the supply side overall. If you had to pick one most important piece, obviously truck drivers are a super important piece of it, of the puzzle as well. And there's lots of important parts of it.
We've got another great slide coming on actual driver availability. So,
so it's a good segue. But when we look at the data from the manufacturers, what we're seeing right now is lower demand, and that's what you would expect after the down cycle we've had in rates. And frankly, we would have expected it sooner, but there's been a lot of pent up demand post-pandemic for supply chain resilience. We think private fleets have been adding a lot of capacity. We think that there's just been a number of factors that are different this time. There was just all these supply chain constraints coming out of the pandemic, and so we had this very long extended backlog, really going up to about 6 months ago. Really, that we had a lot of excess in the backlog. So if you look at the U.S. Class 8 tractor backlog chart on the top right, you'll see that there's about 100,000 units in there at the moment, and it's about 5.5 months long at the current build rate. Now, as an estimated build rate, we actually just got December build rates, and it was higher than we expected. So that actually pushes down on the backlog to build ratio. So it's even probably a little bit lower than 5.5 months. That's a monthly number that's going to bounce around a little bit, but we think that maybe to simplify it, net orders for new Class 8 tractors were about 30% below sales in 2023. So we expect a roughly similar decline in sales in 2024 from 2023. So we're going to add fewer trucks, and you can see that on the right hand side of the bottom chart. Sales have already started to trend down, and once we get to sort of a replacement level, which is in the low teens of thousands of sales per month, that takes away the supply additions that have, in our view, been pushing down on freight rates. And so when you remove the weight on freight rates, we think that's a very significant change in the overall market dynamics, and probably puts in the bottom of the cycle.
Q3 and Q4, the new orders that came in, I think for some at least was fairly surprising. It's much higher than you would expect for this, such an unfavorable market for carriers. As rates are going down, maybe the CapEx starts to slow down. You would assume kind of associated with that. But I'm also curious. You kind of mentioned a lot of these things. The supply chain crunch. Just kind of quick anecdote. The semiconductor shortage. And trying to understand how much of an impact that's having on these elevated new order rates. Compared to where we're at in the market. There were a number of trucking firms that I recall speaking to at that time that mentioned, do you want your truck or do you want a truck with power windows? And they were literally facing the decision of, do you want to have a crank window and kind of forego some of the semiconductor requirements for that new truck order? How much of this is maybe associated with some of that trauma and trying to get through even individual firm, supposed backlogs of what they would anticipate to add on capacity, or what else could be driving this?
Well, yeah, that's a good question. There's a few different things going on. I think one of the things that we did see in Q4, even very recently, was one of the OEMs had some labor related issue. One of them is UAW, and that maybe caused a few hiccups. There were some a few part shortages, more on structural components. I think the semiconductor issues are, as far as I know, largely handled at this point. But there have been some supply chain snags here and there, and then we sort of saw a surge in the year end. So somewhere someone sort of made up for it. And one of our hypotheses around here on why we saw such a strong end of the year in terms of truck production, which beat the manufacturers' build plans by a few thousand units in December. One of the ideas is some of these California regulations that go into effect January 1st, 2024, that will retroactively go into effect once they get the EPA waiver, which hasn't been granted yet. So we'll see on that. But the Advanced Clean Fleet rule in California does limit the fleet's ability to buy certain types of vehicles in the future, and so there was a lot of demand for them last year.
Essentially, they're getting ahead of regulation requirements on equipment.
Yeah, one of the rules in the ports in Southern California as of this year is that you can no longer register internal combustion vehicles at the ports to go in and out of the ports. So anything that's already registered is grandfathered in, but the new vehicles from here on have to be zero emission.
Wow, that's really interesting.
Okay.
Just one other question.
Brett, I'm sorry. I think
we're taking
on track here. We probably need to. There's so many things we can cover here, so it's hard to cover it all. But as we talked about, Tim, I think this is probably my favorite slide right here. The one on the right, particularly. I think over the past year, everyone has been hyper focused on operating authorities, DOT operating authorities, and really trying to understand, well, what does that mean for overall capacity? Are owner operators closing down and then leasing on with a larger fleet, or the drivers just driving different trucks, or what's going on there with overall, how's it actually impacting capacity? And ACT has the driver for hire index. They really paints a picture of driver availability, which is really what it's all about. So what can you tell us here? I thought this one was really interesting, and would love to just better understand where, according to this, where were we and where might we be today and where might we be headed? So
yeah, this one really kind of it ties it all up really nicely. And I think Brett and our idea was when to put these together is to point out that as people are leaving and operating authorities are contracting, what has been happening over the past year is that a lot of these drivers have gone to the big fleets. And what our for hire trucking index represents is we've got several dozen big fleets who respond each month and kind of give us a sense of conditions on a number of factors, but we think driver availability is one of the most important outputs there. And actually, just like a couple hours ago, the December number crossed my desk, and so I can actually report. We've got what I can say just to set this up is that we've had really good driver availability. That's been sort of the sort of bane of the spot market, if you will. It's been very tough to operate in the spot market, frankly, because the fleets are pretty full in terms of their trucks, and there's not a lot of freight sort of spilling into the spot market, but we've started to see a trend change just the last few months where those 60 readings gave way to 55s, and the December number was 50.9. So dropped a few more points. Now at that pace, we're going to be in a tight market by Q2 of 24, like soon. So I think that's fascinating. the benchmark I would look at on this chart, I know 50 is where we kind of put the midpoint, and that in any diffusion index, that's going to be your zero or neutral line. But given that it's always difficult to find drivers, the average over the long term on this index is about 40. So I would suggest that until we get to around 40 on this index, we're not really in a tight market. But anything below 50 certainly is a lot different from what we've been seeing, and suggests that we're going from loosening to tightening. And so I think that's sort of the most important piece. The operating authorities piece is it's great data in some ways, but it's also deeply flawed in some ways, because we're still working on how many trucks per fleet there are, and that number does swing around a little bit. It's tough to get a real precise sense of capacity just looking at the operating authorities. And there's lots of different types of fleets in that operating authority data as well. So directionally, I think it's helpful and tells us that at the margin capacity is already tightening. And then when the driver availability index starts to actually tighten, that kind of closes the loop, if you will.
So
Great.
Tim, basically, and I think the operating authorities, receives a lot of reporting, a lot of headlines. Obviously, you can see in the chart, through the pandemic, you saw this historic rise of operating authorities, unlike anything that's seen in modern transportation history. And now on the tail end of this black swan event, we're seeing something pretty similar to that, to the downside. And I think one of the narratives that's accompanied this, seeing how severe, the drop in net revocations and net authorities is coming, is that, okay, the drivers are exiting, the equipment's exiting. We should be entering into another, upward market. And I think when you put it next to the driver availability index that ACT provides, it really provides a lot of context to where these drivers have gone, because it's almost kind of coincides with right when we go negative at the beginning of 2022. You see this influx of for-hire drivers. So, the fleets have been, I guess you'd call it, I think you even mentioned it's kind of a haven for a lot of these drivers. So they necessarily didn't give up the trade. They're just finding a new place to do it versus, maybe running their authorities on their own. And I think, just my personal opinion on the authorities is that, that in and of itself in a vacuum probably at least can serve as a proxy for individual business level profitability. For a lot of these smaller fleets, owner operators, things of that nature, that led them back to, kind of becoming for-hire drivers instead of owner operators in a way. So I think that's pretty interesting. But can you tell us about where else some of these drivers may have been? You mentioned the major.
Again, I think that's great Q&A conversation. I just want to keep us on track here.
Move into the forecast?
Brett, I appreciate the comments there, but I want to make sure we have time to hit the forecast. I think that's really, that's why everybody, I think, logged in today to figure out, where are we headed?
Where are we headed?
And I think that's this is all leading up to this graphic right here. And just to set it up, the biggest graph we see on the left here is an aggregate spot rate across all modes, a graph depicting that. And we also see intermodal and then contract rates in the bottom right there. So Tim, can you kind of just elaborate a little bit on how all three of these may tie together? And really where we see where are we right now? What can move this graph out to the left or right? Some things maybe to keep an eye on. And then after we've let's give ourselves 5 minutes or so to maybe talk about these slides, and then we'll take some questions.
Sounds good. We definitely set it up right in terms of that spot rate is sort of it's sort of the middle, and I see a question coming in. Has the spot market hit bottom? And that is the question. If you look just at our forecast, the answer is yes. October in seasonally adjusted terms was the bottom if our forecast is right, and we do expect rates to drop here from January into February with sort of normal seasonality, even a little bit worse than seasonality, because we've had a little bit above normal seasonality around the holidays that we expect to sort of fade a little bit in February. But Here's the sort of where the rubber hits the road is sort of right now, and we think certainly seasonally speaking, things are going to be soft for the next few months. That's just totally normal. But at the margin, we are unfortunately still adding some capacity when we look at those new truck sales. And to maybe go back to Brett's question a second ago, the other place where drivers are going is those big private fleets, and private fleets are still adding a little bit of capacity at the margin, and that's really our risk. The biggest risk to this forecast is if we get a surge of truck orders that we're not expecting. That backlog at the moment gets us through Q1 at pretty elevated production rates, but not much further than that. So we think there's a pretty significant change coming there, but we could be wrong. There could be a lot of private fleet orders, and they could still want to continue to grow, and that would probably push this downturn out even further into the future. We think that's very unlikely. Obviously, that's not our base case, but that's the way to think about how truck orders will impact the industry. To go back to your question, Mitchell, about how these are tied together, really, the spot rate is the center of the industry, if you will, from a forecasting perspective, because it's such a great daily leading indicator. And so our forecast for truckload contract rates and intermodal spot rates are very closely tied to our truckload spot rate forecasts. And we kind of believe that if you can understand the truckload spot market well, you can get a lot of other things right in transportation. And with relative ease, but getting the truckload spot market right is not the easiest thing in the world, of course. So what's the justification for these higher rates? I mean, it's what we just went through. I mean, the big question is when we find that balance and things start to move up. I think there's lots of evidence that we're very close. You can see that spot rates have been essentially unchanged since the second quarter of last year. And so that stability says a lot to me in itself, that we essentially couldn't go lower. We had sort of hit marginal cost, if you will. I think we're below cost for any reasonable costs. But now things are starting to turn, and we've already been through a long downturn from a historical perspective. If we're right that October of last year was the bottom, it would still mark a 20-month downturn, which is 4 or 5 months longer than the prior 3 on average. So we've already been through a long downturn. So just from a historical perspective, that's a little bit more evidence. But really, as we look forward, it comes down to what's going to happen with those supply and demand factors we've already kind of talked through, and we think those both move in favor of higher rates.
I think the other interesting thing that's going to be interesting to see this in the coming year is just the local disruptions and changes in spot rates, especially as we're talking about capacity or the containers landing on the West Coast as opposed to the East Coast, and see how those may, even though we're looking at an aggregate forecast, that I think we all have to keep in mind that just because we're forecasting a turn in the spot market or year-over-year inflationary market in the next quarter or two, doesn't necessarily mean that's going to happen in your region, and it may be greater in one region than the next. So that's going to be neat to see to watch unfold in the coming year. So just another thing to call out.
I think that's a great point. I think that east to west shift is going to be a big theme of this year in a huge way. We've already seen spot rates for intermodal off the West Coast increase considerably back in September, October of last year. They haven't really moved up too much since. There's 20-25% moves though back then, and that was during peak season, and so they've held those gains, I guess, into January, and I guess that does is a bit better than seasonality, but as you said, that's just off the West Coast, and most of the intermodal network is not feeling much tightness at all, and the East Coast is certainly going to be at a disadvantage.
Yeah, great. Well, that's a lot of fun. So let's go ahead and move into taking some questions from the attendees. Let me get just a reminder to everyone, please just submit your questions in the chat using the chat. But very first question we have here, let's see, what can we expect to see now that shippers are slowly rerouting their imports from the East back over to the West Coast? I think we've kind of already, actually, ironically, already touched on that one. So, give me 1 second. Let's find something new here. Let's see. Okay, here we've got one right here. So, any thoughts on private fleets, advantages versus disadvantages? I guess that's probably one of those things that depends on what market we're in, and but Tim, I'll pose that to you. What are your thoughts on private fleets in general, advantages and disadvantages of each?
Yeah, that's a great question. We are actually, I'm going through the MCMIS database from the FMCSA to try to parse out exactly which trucks are private versus for hire. And I'll get back to you soon with answers on that. But we think it's roughly 50-50 when we think about Class 8 tractors. Certainly more of the day cabs are in private fleet operations, and sleepers for for hire market, just in general terms. But when we think about the advantages of owning your own equipment, for a retailer, if you're already using a lot of for hire truckload, fleet capacity, there's certainly advantages to bringing some of that in-house. Having control of your supply chain increases. There's a lot more flexibility of how you use that vehicle. It's there's also risks and costs involved, and we think that the for hire market at the moment is something like $1 per mile cheaper than private fleets.
Wow.
And that's not even the spot market. I'm just talking about contract.
Okay.
Because private fleets are just inherently less productive. There's going to be a lot more empty miles. They're not filling their backhauls most of the time. Some of them do enter the for hire market and pick up backhauls and reduce their deadhead. But deadhead, in the for hire sector is something like 10 to 15% versus probably 40% plus in private fleets. So that kind of puts them at an inherent cost disadvantage. And in general, on top of that, they tend to pay their drivers, on average, a good bit more. So it's a pretty significant cost disadvantage. Now you're buying yourself resilience, flexibility, those kinds of things are important, obviously, these days. And I understand why the industry's been, doing that for the past couple of years in a pretty big way in terms of rebuilding that. But at some point, cost economics start to matter more.
Right.
Yeah, Tim, it seems like this is maybe a trend of kind of opportunism. You mentioned resilience and some of the strategies that might be driving this, but you think about the for hire, driver availability. You've got drivers that are potentially looking for jobs as they, maybe set aside their authorities. One other interesting thing I just want to call out quickly is, ACT Research reports on used truck prices from dealers, which I thought that was a very insightful graphic with some good statistics that, kind of right before the rates peaked or right around that time in 2022, a used truck with 4 years old, almost 500,000 miles on it was going for $140,000 at the peak. And now fast forward to today, there's been this dramatic slide that's kind of mirrored what we've seen in the spot market, down to about $60,000, kind of down to, I guess we'd call it more normal levels, pre-pandemic. That is this providing just kind of a fruitful opportunity for shippers who wanted to go after a strategy. Maybe they were burned during COVID, wanted to invest more in that resilient owned capacity. Are some of these factors just proving to be a very fruitful opportunity for shippers to even go after this?
Well, yeah, I mean, I don't think a lot of shippers are going to be buying a lot of used trucks, if that's what you mean. I think they're going to be out of that market and then typically buying new equipment. And I think it really is the owner operators who are going to be going after the used trucks. They have come down quite a bit, and at these rates, it's hard to justify. I mean, you do hear about people going out and starting their own trucking company. Even today, it happens, but not many. And actually, one of the really interesting sort of changes in trend, not to to go back to that DOT operating authorities. In the latest month, when things got worse, it wasn't necessarily the revocations that got worse. Those stayed at similar levels. It was the net worsened because fewer people came into the industry, and so that was interesting. There's always going to be new entrants, and some of that's seasonal. But the point is, it's very tough, and I think used truck prices are a great. Are a great sort of following indicator behind spot rates, and that kind of suggests that we haven't quite found the bottom yet, on those.
Great. Okay. I've got another question here. This is continuing a little bit similar to what we've already discussed, but you mentioned Class 8 truck orders are down. Can you elaborate on why the private fleets are expanding?
Yeah, some of it's timing, right? Like the expansion is sort of all the trucks that were ordered a year ago, maybe, and a lot of those orders came in when things were extremely supply constrained, and a lot of what's happened over the past year is just taking delivery of that. Now, looking forward, the orders are down, and so they're not doing that as much, and so that tells us that 24 is going to be different from what we saw last year, and that's the good news. Is not that different, and we're not suggesting a sharp downturn in truck production, but going back from adding capacity to the fleet to taking a little bit out this year.
AB5. Okay, so any thoughts on the effects of AB5 on the truckload employment numbers from the BLS?
Honest, I'm not sure I know the answer to that.
Okay, I'm not quite sure of the impact it might have, but I'll point out another thought here on the BLS. We talked earlier, lowest jobless claims report since, and this is kind of shifting a little bit, but still with the BLS, lowest jobless claims report. This came out this morning since September of 22. What impact do we think that may have on volumes even in the coming year or next 18 months even?
Yeah, it's a good question. I touched on it maybe a little bit earlier, but I think it just generally tells you that it's a strong economy with a strong labor market. If we've got low claims, that means we've got a lot of jobs being added. If that means GDP is growing, there's more consumption happening.
It's hard to get those three. It's hard to count on those 3 rate cuts if we continue having jobless claims like we're seeing right now. But then again, it's a strong market, maybe we don't need it. So
yeah, it's for a good reason, right? Like
right, yeah.
Yeah, so I think it's a good news thing. I think the piece of caution to keep in mind, of course, is if wage inflation gets out of control and we get too tight, that could be inflationary again. And not only maybe things get bad, we could start talking about rate increases again. I'm not suggesting that's a likely event, but that's the direction that could go if things are too strong. I think it's mostly a good news, kind of I don't want to use the term Goldilocks because again there are inflation risks, but it's a good news thing.
Great. Now, for both of you guys, and on this next question, fuel. Any insights on fuel forecast and the effect it will have on 2024 and 2025?
I can jump on this. We've been sharpening our fuel forecasting a little bit here. We actually recently hired a economist from General Motors who spent decades forecasting currencies and commodities there. So we're amping up our firepower there.
Great.
What I would say is that one of the things that is happening. I mean, there's obviously a lot of oil price risk right now with everything going on in the Middle East. You would think oil prices would be a lot higher than they are right now, but certainly, we're on one side of the Arabian Peninsula with the violence, not the other. If things go over the Strait of Hormuz, where about a quarter of the world's oil production travels through, that's going to change fast.
Yeah.
So that's the big sort of risk in my mind at the moment. But overall, oil production is, domestic oil production here is at very healthy levels, and electrification of light vehicles around the world is gaining some pace, and so that's taken a little bit away from oil demand. And meanwhile, you got OPEC who's losing members. I think it was Angola who left recently, and so a little bit less cartel power maybe, and so we're sitting at West Texas around $72, I think, at the moment, which is a pretty low price for given all that's going on in the world. And so generally that's good news from and that certainly has been helping the inflation picture. Some of it lately is probably seasonality too. I mean, it's not the biggest driving season right now, so things certainly could change as the year picks, as we go through 2024. Seasonally prices do tend to rise in the summertime, and if we have further conflict related risks playing out, then you could certainly see this situation change. But at the moment, it's pretty benign.
Yeah, I just want to add some context from the freight standpoint, just with oil markets. But, you go back to the last major recession, 08, 09, diesel prices actually spiked as the economy was slowing down. And it led to, historic number of bankruptcies in the trucking sector, just wiped them out. We've seen a little bit of the opposite. We did experience some really high diesel prices at the onset of the Ukraine war, but really, as the freight market has turned and rates have come down, diesel prices have also come down from some relatively historic highs at the same time, that I think actually helped drag out this downswing a little bit longer. You mentioned this, Tim, it's longer than average for this point in the cycle. So, diesel prices come down was a tailwind for trucking firms on their operating expenses, allowed them to absorb a lot more of the revenue hits for a longer duration. So I think that's one factor we have to kind of keep in mind as we went through this, is that we did have a couple different levers, kind of being pulled that were impacting this, but oil prices actually have served as sort of a tailwind to keep a lot of these trucking firms afloat during this.
Yeah, I think that's fair. And while you want your carriers to make it through, like we also want capacity to contract. It's one of those tough, tough, awkward things. But I think you're absolutely right.
I think the other big difference between the 08, 09 or prior recessions or market turns would be just domestic production. It is the highest numbers we've ever had, and we continue to add additional wells every month domestically. So I think it just insulates us a little bit more than we've ever seen in the past 20, 30 years at least from geopolitical tensions and how that may spike oil prices. Just acts a little bit different. Or some of those events have a little bit of a muted impact on the market than it would have had 5 or 10 years ago.
Yeah, actually, that's probably the biggest upside risk to oil prices, Mitchell, is if these low prices sort of disincentivize that strong production we've got going on here. I think you're exactly
That's true.
right.
No. Yeah. Okay. So I think we have time for one last question here. Let me read it here. Okay. So, sorry. Let's see. All right. So we're seeing more and more reports of the southern border closures and delays. With Mexico now the top U.S. trade partner, are there any freight-related predictions in regards to that ongoing issue?
Of nearshoring? Yeah, that's a great. It's piece. We didn't really talk about it as part of our freight volume forecast earlier, but it's definitely a piece of that puzzle. When we get to sort of robust growth later this year into next year, we expect a pretty strong industrial economy. There's so many projects. There's more billion-dollar projects starting. Going on and starting in the near term, pretty much than ever before in this country, from not just in Mexico, though, in the U.S., and it's definitely going to feed on itself. I think you've got a lot of companies building here, but you've got a major shift down in Mexico. The peso it's the only currency in the world stronger than the dollar, and it's a lot stronger. So there's massive investment going into Mexico. And it doesn't look like that's going to end anytime soon. Certainly, it's not just U.S. companies. There's a lot of different companies that are investing in Mexico right now. So it's a fascinating piece of the freight puzzle. I do think the industrial cycle over the next few years for the North American economy is going to be broadly positive. Cross-border volumes are not growing like you might expect at the moment. They're kind of flattish year over year, but after some really strong growth the last couple of years. But I think that's going to continue to trend higher.
Great.
Yeah, Tim, I think one thing that was really interesting too is, Mexico also is the top export partner when it comes to Class 8 trucks, kind of bringing it back to the trucking equipment market. I think that's a very interesting dynamic. You think about all of the de-risking or decoupling from, Asian-based supply chains, Chinese-based supply chains, nearshoring to Mexico. You're seeing a lot of that investment, and you're kind of talking about that. I think that's just another interesting component of this, given just the intricate nature of our two countries and our kind of joint economy, on some of that front. I think that's really interesting. I do want to make one comment that as we see these volumes pick up from a U.S. surface transportation standpoint, a lot of those border crossing markets will experience some tightening. You'll also see a lot of these carriers chase the volume, chase the rates. So I would expect a lot of carrier networks to also kind of prepare for some of these volume changes, the West Coast, cross-border from Mexico, and see a lot of these units start to reposition to capture the rewards that come with that volume.
I think that's very fair.
Great.
Yeah.
All right. Well, thank you. As we're coming to the end of our time, unfortunately, I think we could do another hour if we wanted to, especially with this Q&A format. I think everyone enjoys it. I hope everyone listening has enjoyed it as well. But Tim, thank you for joining us. Very helpful, very informative. I know there were a lot of questions that we weren't able to get to, unfortunately. So I want to, when we have those, and we'll try to follow up with you guys and answer them the best that we can. We also, just to point out, I have my email on here, my cell phone number. I love talking about these things. So if anyone cares to reach out and talk further, call me, text me. You have my phone number. Don't hesitate to reach out. We will have a recording of this available next week of our time together. So we'll make sure that everyone receives a copy of that. And just thank you all for your time today. Thank you for attending, and I wish you all a successful 2024 and best of luck.
Thanks for a very informative discussion.